The stock market isn't always about the big, flashy names or billion-dollar giants. Sometimes, the most significant opportunities are hidden where almost nobody is looking. Deep in the penny stock market, you'll find companies trading for just a few cents. They're often ignored by analysts, avoided by large institutions, and dismissed by the majority of investors. But if history has taught us anything, it's that a low price doesn't always mean low potential. Today's video is about one of these hidden opportunities, a US penny stock currently trading near 22 cents. You won't find it trending on social media. It's not being pushed by influencers. And let me be clear, this is not some get-rich-quick scheme. Instead, this is the story of a real company operating in a real industry that has been quietly surviving while many others have failed. In this documentary-style breakdown, we're going to explore why this stock is priced so low, what hidden advantages it might hold, and why some investors believe it could be preparing for a significant move. Let's dive in. Many investors see a 22-cent stock and immediately think it's broken, worthless, or on the brink of bankruptcy. But in reality, penny stocks trade at these low prices for a wide variety of reasons, and not all of them are a death sentence. A stock can fall below $1 due to widespread market fear, a downturn in its entire sector, shareholder dilution, or temporary financial struggles. Sometimes, the business itself is still running, bringing in revenue and serving its customers, but investor confidence has simply vanished. At this level, expectations completely collapse. Institutions sell off their positions. Analysts stop covering the stock. Trading volume dries up. And this is precisely the moment when a stock can become mispriced. A 22-cent stock is already being treated as a failure by the market. That means any potential bad news is likely already factored into the price. When expectations are this low, even small positive developments can trigger huge percentage gains. This is exactly why experienced high-risk investors keep a close eye on penny stocks, not because they're safe, but because they can offer an asymmetric risk-to-reward setup. The real key is to identify which of these low-priced companies still have a solid, functioning business behind the stock ticker. Thanks for watching. The company we are discussing today is not a concept stock or an empty shell. It operates in a traditional manufacturing and materials-based industry, supplying products used in everyday applications. This matters. Unlike many penny stocks that rely only on press releases or future promises, this business produces tangible goods. It deals with raw materials, production processes, and customer demand. The industry itself is not exciting, but it is essential. Construction, renovation, and commercial supply chains rely on these types of products year after year. Even during economic slowdowns, demand does not completely disappear. The company has faced challenges, rising costs, pressure on margins, and investor skepticism. But it has continued operating rather than shutting down. That persistence is important. Many penny stocks disappear quietly. This one didn't. When evaluating ultra-low-priced stocks, survival alone is a signal worth studying. It suggests the business still has a reason to exist, even if the market has temporarily turned its back on it. Now let's talk about what most investors overlook. First, this company generates real revenue. The numbers may not be impressive compared to large corporations, but revenue confirms one thing: customers are buying the product. That instantly separates the stock from hundreds of penny stocks with no business activity at all. Second, this is an asset-based business. The company operates with physical products, production capability, and operational infrastructure. Asset-based companies tend to have better recovery potential than idea-only startups because they can restructure, optimize costs, and adjust output. Third, expectations are extremely low. At $0.22, the market assumes failure or stagnation. That creates leverage. Any positive shift, stabilization, efficiency improvement, or modest growth can change sentiment quickly. Fourth, the sector itself is cyclical. Manufacturing and material-related industries move in cycles. When conditions improve, surviving companies often benefit disproportionately as weaker competitors exit the market. Fifth, retail investors underestimate time. Most traders want fast results, but slow recoveries often produce the biggest percentage gains. Penny stocks that move from 0.20 to 0.60 don't need miracles, they need patience. Now that you understand the structure, strengths, and positioning, it's time to reveal the name behind this setup. The stock we're discussing is Northand Corp. Ticker NCL. Current price approximately 0.22 per share. Northand Corp operates in the manufacturing and material products space, serving residential and commercial markets. The company has faced pressure from costs, competition, and investor sentiment, but it has continued operating instead of disappearing. This is significant. Many penny stocks reach $0.20 because they are on their final path to delisting. Northand Corp, however, continues to report operations, maintain listings, and attempt to stabilize its business. The market does not reward survival immediately. Often, stocks remain suppressed long after the worst damage is done. That delay is where opportunity sometimes forms. Northand's price reflects skepticism, not certainty of failure. Investors are essentially betting that nothing improves. If they are wrong, even slightly, the re-rating can be sharp. This does not make the stock safe. It makes it interesting. Potential upside does not require hype. It requires progress. Possible drivers include better cost control, revenue consistency, sector recovery, improved investor visibility, reduced selling pressure. None of these guarantee success, but together they form a realistic pathway for gradual improvement. At penny stock levels, sentiment matters as much as fundamentals. When selling pressure dries up, even small buying interest can move price significantly. That's how low-priced stocks begin unexpected runs. Let's be honest, Northand Corp is a high-risk penny stock. There is no guarantee of recovery. Dilution, slow growth, or further decline are all possible. This stock is not for conservative investors. It is for those who understand volatility, position sizing, and risk control. At 0.22, the market is already pessimistic. The question is not whether risk exists, it's whether the price already reflects that risk. That's the calculation investors must make. The stock market rewards patience, not noise. Before the headlines, before the hype, before the volume spikes, opportunities often sit quietly, unnoticed. A 0.22 penny stock will never feel safe, but sometimes it doesn't need to. Northand Corp is not a promise. It is a possibility. A company that survived, operates, and trades at a level where expectations are already crushed. For some investors, that alone is worth watching. For others, it may be too risky, and that's exactly how the market should be.